You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Thanks everybody for tuning into this week's episode of the Tax Smart REI Podcast. Today we're joined with Tilden Moschetti, a syndication attorney. We're going to be talking about what you need to know for your first syndication deal from a legal perspective. Subscription agreements, PPMs, operating agreements, all of that good stuff and much more. We'll be diving into all of that in just 1 minute. Tap into real asset ownership with mineral rights and working interest opportunities, a smart way to invest directly in oil and gas production. Gain monthly income potential, upside exposure to commodity markets, and equity in the ground. Even better, mineral rights qualify for 1031 exchanges, allowing you to reinvest the proceeds from real estate and other qualifying assets while deferring capital gains. This is real estate under the ground, titled, deeded, and owned in perpetuity. Whether you're seeking cash flow, long-term wealth preservation, or favorable tax treatment from working interests, these opportunities offer hard asset advantages with energy market upside. Don't just watch the oil and gas industry grow, own a part of it. Contact Eckert Enterprises today at eckertenterprises.com/taxsmartrei to learn more about how you can put mineral rights to work in your portfolio. Again, that's Eckert Enterprises/taxsmartrei to learn more about how you can put mineral rights to work in your portfolio. That's it for now, but we'll dive right into today's episode. All right, and we're back. Tilden, thank you so much for joining us today. Before we dive right into syndications and all the legal stuff that people do need to know, would you mind just giving us a quick background of like your career, how you got involved in syndication law?
Yeah, so I came to syndication law as a syndicator. So I was practicing law as a real estate litigator for about 9 years. I was pretty unhappy in that world because there's a lot of animosity and a lot of fighting, and fighting every single day is a little bit wearisome. So I started dabbling a little bit in brokerage and a little bit in just investing my own deals. And one of my brokerage partners showed me this deal. It looked like an amazing deal. And I said, yeah, this looks great. He said, well, let's syndicate it. And I said, oh, okay. I had very little idea what that was at the time, but I figured I'm a lawyer. I can figure it out. And I did. So I did that deal and I did the next deal, and I got better and better at putting those sort of deals together. And I thought, well, why am I litigating anymore? This is so much more fun. I can help regular people put their deals together as well. And then the rest is history.
Great. So it seems like you walk the walk from the syndication perspective too, not just the legal side.
Yeah, I think that kind of makes me a little different. And as I've been, I've sat across the table from the people I'm pitching. I've talked to investors. I've had to market my own deals. I've had to make the tough choices on, well, do we have our money go hard on a real estate deal or not? So I've been there. And so I bring that to my practice. I like to bring a real pragmatic, get the business done, get the deal funded approach.
Yeah, that makes a lot of sense. Maybe we'll have to dive into some of that later on in the episode here, some of that personal experience there. So we have a lot of people on the show, a diverse listener base. I would say we have some seasoned syndicators tuning in, but we also have a lot of individuals and smaller partnerships who might be considering syndication for the first time and may not know exactly when it makes sense to kind of get started. So from your experience, obviously there's cost to going through a syndication, both from a legal and accounting and tax perspective and what have you. Are there specific deal sizes or capital raise requirements where you would say it makes sense to consider syndication versus not doing one, perhaps?
Yeah, to me, the break point is at about $1 million. That said, I've had clients who are raising about 200,000. I've had clients raising 4 billion. So somewhere in there is kind of the normal sweet spot. But I think the cost of fees and the kind of returns that are normal, especially in a real estate deal, start looking like it's a good payoff for everybody involved at a raise over $1 million.
Yeah, that makes a lot of sense because just to even justify, all the compliance that goes into it, there has to be some meat on the bone, so to speak.
Exactly.
Do you see people starting with are they doing single family homes, multifamily commercial? Is there a mix? What do you normally see people starting to syndicate?
It's totally varied. So people bring with it mostly if they've been investing before, they're investing in the same things they've been investing in. So whether that's, a single family home or, a pool of single family homes, or, while they're a developer and they've been using their own money before, or all the way to, hey, we're going to, land bank, or we're going to build out this little giant resort, or it kind of depends on whoever needs the capital at the right time. This is just the best mechanism to do it nowadays, with bank rates being so high and being able to put a good deal together.
Do you ever see people syndicating businesses like outside of just real estate?
Yeah, about 20% of my work is syndicating businesses. There, I've done everything from fintech to manufacturing to even real estate, like other services, things like that.
Cool, cool. So it seems like syndication's a good tool overall, having your tool belt kind of when you get to the point where you may need to raise $1 million or more of capital.
Yeah, because the advantages really are it's easier than qualifying for a bank loan because you're working with investors who are willing to take a lot more risk than any bank. So we've got those kind of benefits. But we also have the benefit for businesses of, they don't have to worry about a venture capitalist coming in and stealing their business, right? They still get to maintain probably 100% control of their business while still getting the money for growth or whatever it is that they need the funding for.
Makes a lot of sense. Shifting gears a little bit into the legal side of like support that syndicators may need. When, say, for example, I'm in the shoes of a new syndicator, I'm going to go out, syndicate my first deal. Everything makes sense from an investment perspective. Now I'm ready to get to the legal side. What do I need to consider? What am I looking at from a legal perspective in terms of what do I need?
Well, so a lot of the first questions I get is like, well, what's my structure going to look like? And so that answer almost always starts out with two entities, right? So you need two, most of the time we use LLCs, but two entities. So you have an investment entity, and that's the entity or the LLC where your investors are putting their money in. So it will hold the assets most of the time. It will be kind of that thing people think about as the investment. The other entity is the management entity. And so that is most of the time set up there in order to control that investment entity. So it's not only how the sponsor or the syndicator makes their money gets funneled through there, but it's also what they use to control that entity. So making those decisions about when to buy, when to sell, when to hire a new property manager, or whatever it is.
Right.
As far as like the documents that are needed, like people throw around, PPMs, operating agreements, subscription agreements. Can you just like kind of make sure that's like the full list that you normally are looking at? And then secondly, on top of that, can you just give us like a quick blurb of like the main differences between those three things and like why they're relevant?
Yeah. So the PPM or the private placement memorandum, it's the document that I like to say it's the document that when you go to the bank and open up a checking account, it's that big book that you don't read that they give you. That most of the time is the PPM. Now, there will be a lot of investors that aren't going to actually read it, but that doesn't mean it's not a very, very important document. It's the document that at the end of the day, when an investor has a question or they're a little upset about something, it's the thing you get to point to that says, see, I told you about this. So it's a very important document. I like to think of it as kind of like this is the playbook of how the whole deal is going to go. It's terms, risks, conflicts of interest, those sort of things. Then you've got your operating agreement. That's the rules for the investment entity. So this is what the manager uses as the absolute rule book for that entity about when we're going to buy, when we're going to sell, what the manager is allowed to do, how we make distributions, how we handle taxes, all those things are in the operating agreement. The subscription agreement is what the investor signs, and it's in exchange for $100,000, I'm buying this membership interest into this investment entity. It has a few other things that we do. Say, yes, I did get a PPM. I did read it, things like that, just in order to protect the sponsor, to make sure that all those bases are covered. So those are kind of like the three main ones. We also do an investor questionnaire, which is helpful at tax time. It's helpful for crossing a few T's, dotting a few I's. And then also is, of course, the Form D, which gets filed with the SEC to put people on notice that, yes, this is a real deal. And then you have your blue sky notices, which get noticed to each of the states. So every state has the right to be noticed if they have investors from that state. Once a Form D is filed, we then file the blue sky notices to notify the states.
Okay, great. And two questions. I'm going to take these one at a time with you.
Sure.
Number one, can you help us understand when do we need to start filing documents for the SEC? What are the rules, the requirements to say, hey, once you do X, Therefore, now you need these kind of SEC documents. What are we surpassing to say now we're required to file these SEC documents? That was my first one.
Are you asking like beyond like say me and you just partnered up, right? And we just did, yeah. When does it become a syndication versus when is it just a partnership, right?
Yeah. So a syndication, it becomes a security. That's a legal term. Once there is something put together where there are investors that are expecting to make money and they're relying on the services of a third person. And so that's the manager or the sponsor or the syndicator. So if they're relying on the services provided by them, even if it's your mom's investing in this and she's relying on you to do the work, that's still a security. Now, your mom's probably not going to sue you, so if it's just your mom, I wouldn't really worry about it. But it is still a security at that point. So it can be also any dollar amount invested. So a lot of times I'll hear from people, well, we just raised $100,000 or $10,000 or whatever it is. It's actually any amount. So the rule says even a dollar counts as a security as long as there's that expectation of profit that's relying on the services of a third person.
Okay. So basically, if we were going to try to get around that, I'm sure there's multiple ways. But basically, if like going back to mine and Tom's example, if Tom and I were just GPs on a deal and we were both just contributing capital, there's no security there, right? There's no,
because as long as you both are working together, you're making the decisions together, and it just looks like a real partnership, then it's not a security at all. Or if you had an investment club, if you had 10 people, but you meet every quarter and you talk about where things are at and everybody's deciding every quarter, on well, let's do this or let's do that. That's not a security. That is just a group of people going in. It's a true partnership that's just functioning that way. But once you guys as the GPs are putting this out there, bringing in those other investors, and the investors are just sitting passive or even just look like they're sitting passive, like just say, well, we've got an operating agreement that says we vote on everything, but you've told them, hey, you don't actually have to show up. You're actually putting them in a passive role. And at that point, it becomes a security.
So maybe like a good litmus test would basically be if there's a GP-LP kind of structure, right? Basically, as soon as we see anything like that, then we're kind of thinking this is a security, and therefore we've got some SEC requirements here. Okay. My last question for you at this point was just kind of when should people, as they're thinking about starting a new one or maybe their first one, when should they start to evaluate kind of your services? At what point of the process do we say, hey, you're ready to start working with an attorney on this?
Sure. So really, because we can't accept money until we have the paperwork done, that's kind of the main thing that goes into the equation on when I get brought in or when any kind of securities attorney is brought in. So sometimes that's brought in way early because they want to, get everything ready. If they're going to be buying really hot multifamily properties or something like that have very short closing times, they probably need that pool of money before they even put a property in under contract. So I may get brought in 6 months before they even find that property to put that structure in place so they can get the investors and build that pool of money. Sometimes, though, the deals move slower and it's a long-term development project. So they're waiting until they're about to close or they're, waived all their contingencies or something like that before I get brought in. It's really that point in time where, okay, we need this period of time before we need to raise all that money to bring it in. That's when I get brought in. Now, even if the deal falls out, my personal practice, and I think I'm different than other attorneys, is I do unlimited revisions. So even if 123 Main Street falls out, which is the property that you thought you were going to get, we just rewrite it for whatever the next deal that comes along is. So it takes that risk of, now we got to pay the attorney again to redo all the documents. I thought as a syndicator, that would be a really big deal. So I made sure in my practice to get rid of that risk.
Yeah, that's great.
With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode.
And at what point in like the capital raising process should they be reaching out to you? Is that pretty early on in the process usually?
Yeah, and it's pretty flexible as well. So the two thought processes are you can definitely talk to anybody you want, right? So you can talk to people about, hey, I'm thinking about putting together this deal to do this. You don't need me for that. But the other thing that has to go through your mind is once they say, oh, yeah, that sounds really good, I'd be interested in investing in that, you really want to be pretty ready to give them documents in order to collect their money, because otherwise that money's going to go away. They're going to spend it somewhere else or invest it somewhere else. So part of the calculus needs to be, well, when I'm talking to people, how ready do I need to be in order to get them the documents, in order to get their money, in order to make the investment?
All right. Not to jump all over the place here, just want to circle back to the entities real quick. I know you mentioned there's the management entity and then there's the investor entity. Why is it important that those are separated from a legal perspective?
Really, it's a liability issue. If in the unfortunate occurrence, which is pretty rare, but it still happens, that an investor gets mad and they want to file a lawsuit, they're going to name two people, right? They're going to name the investment itself. They're also going to name who controls that. Now, we don't want the assets of the sponsor, of the syndicator, exposed in a lawsuit. We don't want to make it available to everybody. And so we put it in an LLC. Its only job is to control that investment entity. So even if it gets sued, you just close that one and restart another one, in the absence of fraud or anything like that.
That makes a lot of sense. People's got to cover their bases and protect their assets, right?
Yeah.
So kind of along those similar lines, like what are some mistakes or misconceptions you might see first-time syndicators make?
Yeah, I'd say there's three. Either I don't know, I don't need to do the documents, or I don't need to go under Reg D, like we talked about before. I think the other ones are related, and I don't think it's going to be hard at all to raise money. Raising money is not easy. It's not impossible by any means. If you do the work, you're going to be able to find investors, and you're going to be able to do it as long as it's a good deal that underwrites. But it's not just simple. And related to that is, well, all I have to do is put it on the internet and I'm going to get 1 million investors. That's not true. The investors are going to want to talk to you. Nobody is going to want to give you $50,000, $100,000 without talking to you on the phone. At least I've never had that experience where somebody has wanted to just give me money without talking to me first. And I don't think anybody else has either. And so the raising money game is a key thing because, especially in real estate, the contract cycles really matter. Timing matters. When a deal needs to go hard, you're going to have a seller who may have other offers that are waiting in the wings that they like a lot better. And if you're trying to say, well, no, I need a little bit longer before I waive my contingencies, they can very easily say, no, we're not going to do that. So plan for a lot of time to raise money is kind of the big story here.
Yeah, I would agree with that. Just to give my personal anecdote, back in 2017, so this is quite a bit now, 8 years ago, we syndicated a deal, me and a few partners, and one of the challenges we had the deal, was actually raising the capital for the deal. And I kind of realized my biggest takeaway from that was that you need to have the runway. You need to start kind of building that capital or that investor relations engine, so to speak, well in advance of finding the deal. We ended up getting it done with a crowdfunding platform that ended up being able to come in with the capital at the time, which was good and bad, had its pros and cons to it. But yeah, definitely agree with that. Definitely need to get that. It's not as easy as you think. The money is just not going to come to you. And there's a lot of competition for capital these days. That kind of brings me to another question. Is 506C and 506D still the predominant ways of raising capital, or are there other exceptions or other ways people are doing these days?
506B, not like 506B like boy. 506D is for bad actors. So no, that's not on the way. But 506C is, both of them are the way. And really your decision point is where are those investors coming from. If you know your investors, you're going to use 506B. It's a little bit simpler. You can let non-accredited investors. If it's 506C, then you can advertise, but everybody's got to be accredited.
Right. That makes a lot of sense. Hey, real quick, if you've been a long-time listener to the show, then you know we give everything away for free, from how to use the real estate professional status and the short-term rental loophole to save tens of thousands
one
of
other thing,
dollars
as
in
we're talking
taxes
about this,
to upcoming
I've
tax
always been
changes,
curious
including the
between
potential
when
return
people
of
choose kind of the
100% bonus
structure we were talking
depreciation.
about a couple
We
of
don't
minutes
hold
ago, where it's
anything
just kind of
back.
the
And the only way
LLC
we're able to help
investors
more
kind of
real
put
estate
their money
investors is if you rate,
versus someone
review,
who's doing
and
more
share the
like
show.
an
It just
open-ended
takes
fund,
15 seconds to
right?
leave a quick
Is
rating,
there a major
review, or
difference
share with a friend
from like
who
a
may
legal
find this information
perspective as
useful
people do
on their
more of
real
like an
estate journey?
open-ended fund
That's
where it's
all
like,
for now.
hey,
We'll
people
dive
can just
right
kind of
back
continue to
into
put money
today's
in
episode.
and it owns all sorts of assets compared to what I kind of imagined we were talking about earlier, which is like, hey, one investment owns one major asset and it's kind of like, hey, we're done, right? We're closed. What are kind of the major differences there from like a legal perspective?
From a legal perspective, it's not huge. So we need to make sure we're talking about redemptions. We need to come up with some sort of mechanism to not dilute the earlier investors. Now, I can create an investment that totally dilutes and punishes the early investors, and then the late investors, they make a ton of money. I could do that legally and it would be totally fine as long as they knew that that was what was going on, but nobody's ever going to invest in it, or at least nobody's going to be the early investor. So we need some sort of mechanism. Normally that's figuring out, okay, well, how are we going to price this asset portfolio according to its current net asset value? And then how do we use that NAV, or net asset value, in order to change the price of entry and exit to the investors in a way that's fair and that will even work, right? Because I'm sure I could come up with a system where it will completely break down and it won't be usable at all. So it needs to be very functional, and it needs to be clear enough that investors kind of know what's going on and how that all works. So that's a super complicated bit. I don't recommend it for early syndicators. It's much, much more difficult, but it's really more difficult from an administration point of view. And I know from a tax point of view, it's a lot more difficult too. Than as a legal thing. I just need to make sure as a lawyer I set that part up right. In terms of notifications and SEC involvement, really all we need to do is notify the SEC every year that, hey, this investment is still raising money. And then we probably need to notify states as more investors come in. But there's not an like, oh, we've got to do all these other legal loopholes that we need to go through.
Yeah, I got another question too, and I've not seen this too much recently. Maybe it's just the circles that I'm traveling in, but for a while there was a lot of capital raisers out there, right? And there's a lot of debate over the legalities of that, from what I've seen. For example, when would someone need to be like a broker versus they're just a GP? Like, so, for example, if me and you, Tilden, we were to syndicate a deal and I go raise capital for it, me and Ryan syndicate a deal, and then me and Joe blow down the block, we syndicate a deal. I'm a general partner on all of these, a sponsor, and I'm going and raising capital from all these people, versus when I'm just a capital raiser, like in sense that I'm just like a mercenary to raise capital for other people's deals. Like, is there a delineation between that?
Yeah, the reality is it's almost always not allowed. So there is this exception that the SEC has, that the securities rules themselves have, for finders. So a finder is somebody who says, okay, well, I know this guy who's probably going to be interested in something like that. It might be okay under very specific circumstances in order to pay that person. But what we can't do is we can't pay them a performance fee. We can't say, okay, I'm going to give you 5% of every dollar that comes in, or every dollar that you bring me, is certainly not allowed. That's what broker dealers do. That's what they get paid for. The person who brings the deal can't be involved in any negotiations. All they literally can do, and the what made no action letter from the SEC on this, I forgot who it was. It was a great golfer, brought a list of people. All he did was send this list of like 200 names of people who might be interested in investing. They paid him $100,000 or something, and that was it. The SEC said, okay, there's no problem there. He's not doing anything other than saying, here's a list of people I think you may want to talk to. Where a lot of these finders are trying to do is crosses the line because it's, well, I want to get 5% or something like that, or they're heavily involved in the deal or something like that. You got to be a licensed broker dealer. So you need a Series 82 or a Series 7 in order to do that.
Got it. So it sounds like there's like a fine line because like, could I theoretically, like I could be a GP with you in a deal. We go find a multifamily property. We're going to go raise capital for it. Same thing. I do the same thing with Ryan and I do the same thing with somebody else. Is that allowed?
It probably is, as long as it looks like you have a regular function in those LLCs. So we normally will assign some sort of job other than that. If your main thing is really capital raising, normally we'll put out there, hey, look, not only is he going to be raising capital, but really what his main job is investor relations and marketing. And he's going to devote a lot of time making sure that all the investors, get regular updates even after the money is raised. So that way, then it looks like you're truly part of the operations team and not just there for a capital raising purpose. And the reason we do this isn't because the SEC doesn't come in and audit the books and see what happens, but how this actually comes up and why it's so important is once an investor gets mad, if they get suspicious that, hey, you were just acting as a finder, all they're doing is telling their plaintiff's attorney, hey, this guy got paid based a performance fee on bringing me in, and I think he told me a whole bunch of things that weren't right. The plaintiff's attorney's job is basically done at that point. He can win that case simple, and that just destroys the entire thing that you've built. So it puts all of your investors at risk. It puts you at risk. It just destroys everything. And they win and get their money back for whatever purpose. So that's why it's so important that we don't do it, because it's not about the SEC finding out. It's about an investor telling a plaintiff's attorney who now has a get out of jail free instantly card, and they're going to win.
Amazing. Yeah. One other thing, kind of changing gears a little bit. So I have seen, some of with the interest rates going up, right, over the last couple of years, I have seen either just kind of social media or people I know where deals are just going bad, or they can't refinance because interest rates have doubled from what they were just a couple of years ago.
Mm-hmm.
So I've seen, people tell me, hey, I completely lost all my money. I put in 400 grand and it's gone. And they said even 2 to 3 other deals. So with that, kind of something that I had never heard previously since I started investing around 2017, and this is kind of a new thing for me. What are you seeing legally? Is there more lawsuits coming about because things like that are a little bit more common? Not to say they are common, but they have been a little bit more common over the last couple of years. What are you just seeing from your own perspective in dealing with your clients?
Yeah, I don't get exposed to it a ton. So where I do see it is from people who see my advertisements or something like that, and they call me because they're upset about something. I only help sponsors, so I rarely talk to people about it. But every now and then I like to talk to those people just because I kind of can hear what's going on in the world. So it certainly is happening. And where it happens the most, from what I've seen, is just bad underwriting and bad ideas about going forward. And then on top of that, most of the time it's compounded by I never hear from the syndicator. I never get a message about what's going on. I've tried and tried to call them. So I think the message for syndicators really is very clear, right? Be very cautious in your underwriting. Just write conservatively. Really think through the risks and identify them for investors. And even more important, I think, is communicate all the time. I've never had somebody talk to me on the phone about how they're mad about somebody losing money, or heard from a client about another deal they did that went bad or anything, where the main story has been, well, my syndicator called me all the time and told me what was going on, with constant updates. So I always knew, but now I'm really mad. I'm going to sue them. It's always, I have no idea what's going on. I don't know where my money is. They will never talk to me or answer the phone. So communicate all the time. And I've seen deals that have gone south where the communication's been fine and the investors aren't happy, but there's no way they're not even talking about filing a lawsuit. There's nothing to file a lawsuit about. They knew that it was risky, and they knew what was going on every step of the way, and they knew the sponsor was trying to solve the problem. So there was nothing for them to sue about. And that's what every sponsor needs to do, is just communicate a lot.
Right.
Yeah, when you don't know what's going on, you just get kind of suspicious, like what is really going on,
Yeah,
and then
maybe
you
they
start
stole
to
my
get
money.
a little bit cynical.
So
Yeah, exactly.
Yeah, that trust slider goes down real quick and all of a sudden you're in hot water. All right, guys, so we're going to have a bonus question right after this. But first, Tilden, thank you so much for jumping on the show today and sharing all this information with us. It really cleared up a lot of stuff. And I think for a lot of the newer people out there who maybe never did a syndication before and have a lot of, scratching their heads like, what do I do? Am I allowed to do this? How does this all work? I think that adds a lot of value for them. If people are listening, wanted to work with you, how do they contact you? What's the next steps there? And who would typically be a good fit to start working with you?
sure. Best place to come in is my website, moschettilaw.com. I'm sure you'll link to it. Or I've got a bunch of videos too on YouTube that kind of go through all sorts of different topics. I think we have like 150 videos on kind of like all sorts of different nuances that may be helpful for people to kind of get an idea. Well, what is a bad actor? Or what is this? Or what do I do in this case? And then the best fit for us is really anybody looking to syndicate. I'm always happy to work with first timers. At the end of the day, my job is to make sure my clients are successful. So anything I can do in order to make it better, to make their job easier, whether it's, coming up with strategies or marketing advice or anything like that, I'm always happy to do, just because the more successful my clients are, they keep hiring me and they keep referring me. And so my business gets better, and then I'm also doing good for the world. So it's kind of a win-win. The only thing I don't do, I should, preface it, is I don't raise money for my clients. So that's for my deals. I raise money for my own deals. I don't raise money for new clients.
That's a good distinction too. And I have to say, because I've been asked this a bunch of times too, we don't raise money for our clients either. So if you're tuning in right now and you're hoping that working with us would be a good way to raise capital, unfortunately, we don't help our clients raise capital either. So just want to put that out there. But we're going to do it.
I actually have kind of a good explanation on why too. So I mean, I think what's my job as an attorney, and your job as accountants, is, I am there as an advocate for my client, right? I am there to be the be all and end all for them. That my only thought process is my client. And if I refer them an investor, then I kind of have split loyalties. I have, me as a lawyer, and then also I have some loyalty to the investor. In this case, I don't, right? My only thought is my investor, protecting my investor all times. So,
And that's important to keep in mind, because there would be
my sponsor, I said the wrong word there. Protecting my sponsor at all times. See, that's why I do it, to make sure I'm not protecting that investor's time.
No, right. Now that makes a lot of sense, because there's a conflict of interest there. It's like dual things that can pull you in two different directions.
Yeah.
So bonus question here we have is, what was your best deal or most interesting deal that you've done?
Best deal was first deal, because I didn't know anything, right? And so I didn't know anything about putting a syndication together. I had to learn it. I didn't know anything about pitching an investment. And so, my first pitch was a sure thing in my head. I should have gotten, at least $200,000 out of that guy, and I got zero. And learning that taught me how to pitch, right? So he was actually really good about it and told me why I didn't get it, and that was what was. Oh, okay, that's how it works. So that was all really, really great. So that was my best deal, or most interesting for me, was for the first one.
Yeah, that makes a lot of sense. A lot to learn on the first one, so it makes it memorable. All right, so we're going to go ahead. We'll drop Tilden's information into the show notes for everybody who is tuning in, who might want to learn more or work with Tilden. So you go ahead and check those out. Tilden, I want to thank you again for joining us on the show today. Again, been eye-opening for a lot of those newer syndicators out there, or maybe people who are jumping into the game. Thanks again, and thanks everybody for tuning in.
Thank you.